So the worst case scenario has happened. Your home's caught in a wildfire, your insurer dropped your coverage, and you're seeing everything you've built quite literally go up in smoke. How do we avoid a complete financial disaster from a natural disaster? In this video, we share 5 essential tips to rethink protecting your assets and finances. So let's dive in. Hey, this is What the Finance by RYSE Financial, where we bring you the latest in personal finance, the economy, and more. My name is Prab, and let's get into it. Tip number 1, can't get fire hazard coverage? If you live in California, look into the FAIR plan. FAIR, or Fair Access to Insurance Requirements, was established to meet the needs of Californian homeowners unable to find insurance in the traditional marketplace. It's often been known as the insurance coverage of last resort. The state legislature created this program in 1969 for homeowners in high-risk areas who were turned away by regular insurance companies, allowing for homeowners to receive coverage until they found an insurer who would underwrite a policy for them. All insurance companies licensed to do business in California contribute to the CalFAIR pool, thereby assuming a portion of the risk of CalFAIR policyholders. So if a house burns down, the claim is covered by the pooled funds. The downside? FAIR policies, ironically I might add, cost more than normal coverage would. According to the Zebra, $400,000 of normal coverage costs $1,523 per year. With FAIR, that would skyrocket to $4,400 per year. Exposure for FAIR rose to $458 billion in 2024 from $153 billion in 2020, even as they explicitly say that their goal is attrition. Insurance Commissioner Ricardo Lara wrote that as the risk of more climate change intensified wildfires increases in California, a major wildfire in one geographical area concentrated with FAIR plan insured properties could overwhelm the FAIR's plan's reserves and its capacity to quickly and fully pay consumers' claims. All of that being said, it's at least an option to ensure some coverage in case you don't have it. So let's move on to tip number 2. Stashing additional funds in life insurance policies. You might be thinking, wait, what? But yes, you can use your life insurance policy in several ways as a vehicle for withdrawing funds for emergencies. As long as you've been contributing to your policy for a while, you've been accumulating what's known as cash value. You're able to withdraw against the cash value when you need to. This is the easiest and most direct way to get access to your funds quickly, but there may be tax consequences. However, another way you can utilize your life insurance policy is taking a loan out of the cash value. It's similar to a withdrawal, but you avoid the tax consequences that a withdrawal might have. In a worst case scenario, you can also sell your policy at a discount, but you would be subject to the settlement company's rates. It's typically not what advisors would recommend, but it is an option if you need it. Let's move on to tip number 3, building your emergency fund. If you can't put your money into a fire hazard policy, take what you would have put into your premiums and stash it in your emergency fund. Given that it's there for you as a last resort, you probably won't want to store it anywhere risky. So a high yield savings account would be the best place to keep your money safe. Keeping an emergency fund in a high yield savings account is a smart financial move for several reasons. Reason number 1, liquidity. An emergency fund is meant to be easily accessible in case of unexpected expenses, like medical emergencies, car repairs, or natural disasters. A high yield savings account allows you to withdraw money quickly and without penalties, unlike retirement accounts or certificates of deposit. Reason number 2, higher returns than regular savings. High-yield savings accounts offer significantly better interest rates compared to traditional savings accounts. While it won't make you rich, it helps your emergency fund keep up with inflation or even grow slightly, maximizing the value of money that would otherwise be sitting idle. Reason number 3, safety. Most high-yield savings accounts are FDIC insured up to $250,000 per depositor per bank, meaning your money is protected even if the bank fails. This makes it a low-risk place to park your emergency fund. Reason number 4, separate from everyday finances. Keeping your emergency fund in a high-yield savings account creates a psychological barrier. It's separate from your checking account, reducing the temptation to dip into it for non-emergencies. Reason number 5, flexibility. While other options like money market accounts or short-term investments might offer slightly better returns, high-yield savings accounts strike the perfect balance between earning interest and having immediate access when you need it the most. But if you do feel like you have some wiggle room, you could also open a brokerage account and invest in low-cost index funds that track the S&P 500 index, which have historically generated a better return most years. But doing that inherently means you're taking on more risk. Let's go on to tip number 4, business interruption insurance. If you are a business owner and you happen to run your business from home, you might be able to use business interruption insurance or a business owner's policy to recoup some of the damages. Business interruption insurance typically applies to businesses, not personal residences. However, there are some indirect ways it could provide financial protection for homeowners in cases like wildfires or natural disasters. Here's how. If you operate a home-based business, business interruption insurance can cover the income you lose if your home is damaged or made inaccessible due to a wildfire disaster. This can help bridge the gap while you repair or relocate your business operations. So as an example, a freelance graphic designer who works from home, they can use business interruption insurance to cover lost income if the wildfire makes their home office unusable. Way number 2, relocation costs. If your business operations are disrupted and you need to temporarily relocate to a new home or workspace, the insurance may cover relocation expenses related to keeping your business running. So for example, a small bakery owner who runs their operation from their home kitchen could use the coverage to rent commercial kitchen space temporarily. Way number 3, utility disruption. If a wildfire damages infrastructure and cuts off power, internet, or water to your home-based business, business interruption insurance could reimburse you for lost income during the downtime. Way number 4, contingent business interruption. If your business depends on suppliers, vendors, or customers who are affected by a wildfire, the policy may actually provide coverage for the indirect financial impact on your business. So if you're a home-based Etsy seller relying on a supplier in a wildfire zone, you could recover lost income due to supply chain delays. Some key considerations to keep in mind: business interruption insurance does not cover the physical damage to your home or belongings. That would fall under homeowner's insurance or a separate business property policy. The insurance kicks in only if the disaster directly impacts your business operations, so you'll need documentation to prove your income loss and the connection to the disaster. And for the final tip, if all else fails, there are multiple grants and programs that are available to help you with your home in case of a disaster, such as FEMA, California's SSGP, or Union Plus. We live in a world where it's become increasingly difficult to get fire insurance coverage on homes in high-risk areas. State Farm dropped nearly 70% of its policies in the Pacific Palisades last year, according to a state filing, more than any other zip code in the state. As a sign, it saw the neighborhood as risky. That forced more people onto the FAIR plan, which in turn is overloading the FAIR plan. To state the obvious, it's unfair to homeowners and ironically defeats the purpose of buying insurance if you can't get access to it. The biggest takeaway with all of this is that the earlier you start to plan, the better off you'll be. You can never guess when disaster might strike. So if it feels like something that you don't have to worry about right now, then it probably means that today is the perfect day to start planning. And if it's all overwhelming for you to handle on your own, speak with a financial advisor to help prepare you and create a game plan. If you've made it this far, please give this video a like, comment with what content you'd like to see from us next, and subscribe for more. This is Prab from RYSE Financial, and I really hope you found this video helpful. Stay safe out there, and our hearts are with you. Until next time.